Good afternoon. Ira Epstein with your agriculture wrap-up, and this is for Thursday, the 20th of February, 2:25 p.m. Central Time. So an interesting day. It's slightly red, in fact, all red behind me in the corn, the wheat, the soybean market, the meal market, the sugar, the cotton market, the coffee market. Get the general impression there? Down day in the grains. Now, we saw the stock market take a pretty big swoon about mid-morning, and it has been bouncing back ever since. Not saying that it's going higher. What I am saying is it's bouncing off those lows. Gold's been a big performer again, attacking the highs and going through them from the day that the Iranians attacked the U.S. troops in Iraq. So that's the first time that we've gotten up there, and this will be a new strong high close for the market. The dollar continues to mount an attack against a number of foreign currencies. Bonds and notes, well, they're still getting bids in the market. But as we talk about the grains, it's a couple of things that did come out. I was listening to the USDA talk, and it sounds as though they're still expecting China will meet its commitments for the year, but that may not begin until their real purchases away from what they, let's call it semi-normal, will begin in the next quarter. Okay, that makes all the sense in the world given what's going on. By the way, in that Wabib province, they have now told people to return to work March 11th. So that's almost 2 weeks from now, just past that if you think about it. So if you're counting on equipment, be it auto switches, be it parts for cars, whatever it is that's made in that province, could be parts for Apple phones and the like. All that they want back to work there right now are people in the medical industry, people that can make masks, the protective equipment and so on. That's what they're looking for. Other factories there to stay away. And now we're hearing about a few more cases in Beijing that broke out. I write about that in my newsletter already. If you take a look at the weekly area chart of closes, for the week we're down a penny. So the market is stalled out. We have one more day left in the week, but for the first 4 days, we've really gone nowhere, so to speak. You see that in the chart action, where the market fell, it got a bounce, and it's just sort of drifting right here. Now, the pattern in the chart is one of a higher high and a lower low, so I don't see a trend. I define a trend as having a pattern of lower highs, lower lows, or an uptrend, higher lows, higher highs. No trend means in some manner you got that higher high and lower low formation. I look to see moving averages. Where's the market fighting a battle? You will hear me regularly say that I think the line in the sand in markets is the 18-day average of closes. And what that is this red line. This line up here is the 100-day. And what I've learned in my experience as a chartist is markets focus on neutral points. To look at a point where if a market's up a lot and it pulls back, where's it chop around? Down a lot. Where's it start chopping around on the other way there? Then it looks to see moving averages as a filter on other indicators. Example, when the market finally breaks away from the 18-day average into a downtrend, I say the bias is down, which triggers my actions, be it on the swing line, saying, hey, it's throwing out sell or buy formations, whatever it might be. I then take another look to see how the algorithm called the Bollinger Band is doing. And the reason that this is important to me, at least, is so many astute traders follow it. It's an algorithm designed to keep the market trading within it 95% of the time. It's going to break out of it. A lot depends on the formation. If the market's in a tight formation, which this one is not yet, it's just starting to form it, well, then you get a better odds that the market's going to move one way or the other. If the market starts a trend down, staying under that band, now I don't think that's the spot you add new short sales. I think it's to the right-hand side of the band, but that's my opinion. I think you get those opportunities. And as you hit these bands, notice how the market finds support against them. I'm not the only one watching this. There are other traders, there's algorithms, they're trying to come out at certain strategies, but I think a Bollinger Band is an important tool for the average person to understand at least, and if not even more professional, using it. When I look at momentum, there are different ways to measure what is a market doing. I hear all the time on TV the relative strength index. I was watching today them doing a show on CNBC talking about it might have been Bloomberg. They were talking about the relative strength in the Japanese yen. I understand exactly what they're saying. I happen to like slow stochastics better, and that's because I discovered it has a personality. It can get oversold, overbought, go flat, or lock into a trend. Now, MACD can do very similar things, but I think this actually does a better job. But it depends what you want. The key is finding momentum indicators. I have an overbought condition, not trending, against my line in the sand. That's my definition. In the meal market, today's formation was one of an outside day down. So what the market did today, rallied back up, unable to get through the last rally high of 299.40. The settlement was 298.30, which is over the 18-day average, but you had still a lower close. As a bear in the market, if you are, you don't want to see today's highs taken out. As a bull in the market, I don't know why you'd be bullish, because you've got the pattern of lower highs, lower lows. Can anything change that pattern? Here's what I see. If the market can clear today's high and then especially get through 299.40, which is only 30 cents more, the odds would then favor price in the, wherever the Bollinger Band is, the making a run at each other. It's just a phenomena that happens on an outside day more times than not, in my experience. I cannot tell you anything other than that. If the market drops and takes out today's low, what it does is it reestablishes, and it's got to take out today's low, that we've got the lower highs, we're reactivating the lower low part of that. Then if you can take out 294.50, wherever the lower Bollinger Band comes in, I'd be looking for the support. What else? This market, when it reopens, is probably going to be close to, if not overbought. It's got a reading of 69.28, and I define overbought as being any number over 70, oversold under 30. In the oil market, yesterday was the first challenge, and I'll take you right here. This is Tuesday. Here's yesterday. The first time you hit a Bollinger Band, you'll hear me over and over say, that's where I think the pros are taking money off the table. Now, that could be an algorithm, it could be a professional trader, it could be for whatever reason. But that's what I believe, and that's what I teach in my charting course. So you've got lower highs, lower lows, you've hit a downside target, the market is oversold, it's got a reading under 30, and today you get a small attempt at a bounce. You didn't close higher. You closed lower, but you're not at that Bollinger Band number either, okay? So trends down, oversold, support still the Bollinger Band. In the corn market, the market has been having trouble at this 18-day average, that line in the sand, and it has kept a pattern of lower highs, and yes, that is underneath this high, and lower lows. Now, if it falls tomorrow, I'm looking for support at the lower Bollinger Band. If it rallies, the key is to get over 87.5. The problem is, if it does, I'm looking at this upper band, and you know my idea is that'll be the first resistance, and that band's falling at the tune of about a penny a day. So as you can see, it's going to be closer to 390. I don't know. I think you can knock out the shorts if you get up there. I don't know that you're going to get new buyers. And then you've got the 100-day averages resistance. So overall, still in the bear camp, but concerned that the market's getting close to being oversold. In the wheat market, the bulls still have control, although the past 2 days, the market is consolidating that big rally we had last Tuesday. This past Tuesday it is. Higher lows, higher highs. So what do I think? I think the bulls are going to support the 18-day average of closes, 555 3/4, 556. I think they're wrong if the market takes out yesterday's low of 551.5. And if the market can rally up, they'll look for this area. Now let's assume that you don't get support there and the market goes through 551.5. As long as you don't take out today's high, you'd have lower highs, a lower low, and put into play the potential of hitting the 100-day average and that lower Bollinger Band. Got it? So you have to have plans both ways. In the sugar market, you went up just yesterday, hit that Bollinger Band again. You know I'm going to tell you, as you come down to the 18-day average, that line in the sand, if you go back up, that's the resistance point. Okay, and the market backed away from it. What's the trend? It's still up. You have higher lows, but now you have lower highs. So you're starting to get the rounding in the market. In order to get another leg up, I need to see 1520 taken out, which is about where that upper Bollinger Band is. In the coffee market, I am not surprised to see this market backing off to the 18-day average of closes. If we take a look at this vertical price rise, I've got resistance coming in this 100-day to upper Bollinger Band area, and to see the market pulling back to the 18-day average while you still have a pattern of lower highs, lower lows, and momentum turning down. Was that no more than just a bounce in this market? We still don't have those stores open in the big cities in China, and now I'm hearing about more COVID-R, the coronavirus disease. So I can see the market backing off a little bit. In the cocoa, you have a market that's got lower highs, lower lows. I think I said just yesterday here that the bears need to close under that 18-day average if they want momentum to pick up. It went down, made a lower low, couldn't do it, and closed higher. You're still in the middle of what I call no man's land. While the swing line's down, the bias is up since you're over that 18-day average, and momentum has been correcting an overbought condition. In the cattle market yesterday, I was looking to say, do you get over that high or do you get under this low? Which one's going to give the trade possibilities? As it turned out, you broke under the low, not the highs, so now you're in a downtrend, lower highs, lower lows. Will there be any legs to the move? Not sure, and here's why. You have the cattle on feed report tomorrow. A lot of traders don't like going through these reports, so it's something to keep your eye on. Last in the lean hogs, we have a pattern of higher lows, higher highs. Trend up. What's the momentum index? The number's 71.95. It's overbought. So normally I'd be saying I'm looking for the pros to support the market. Well, that doesn't change, but it's still overbought. Certain people in their filter of trades won't do anything. Support is back at 65.42. Unless you take out this low right here of 63.10, the trend is up, but it's overbought. So something to be concerned with. You know, if you look at this, it's Modern Trader, and these are technical tips from the top pros. Remember how I talked to you here? You just heard it. Well, you're going to see a lot of this in these articles that they've got. It gives you ideas, though, with things you might not have seen. What does the square of 9 mean in Gann? Do you have any idea? Traders use it. The absolute benefits, well, maybe benefits of relative strength. Did we not just talk about momentum? Trading with the money flow index. Do you even know what it is? Here's something I don't believe in, but if you're going to be one, bottom fishing. I am not a top fisher or a bottom fisher. Having owned brokerage firms over the years, these are the kind of people that generally burn themselves out. I want to be with the trend. I don't want to be fighting the trend. I'm not interested in the turning point. You go broke trying to catch turning points in markets. And optimizing stops, absolutely an important part in the market. I don't care if you're optimizing, you have money management rules. In some manner, where are you wrong? And that's how you formulate plans. So in order to get this, and we have many things like this that you can get from us, you go to our website, and by the way, these are how the articles look, and everything's got neat parts to it, graphics that explain what it's doing. But in order to get this, we've put it together as a PDF for you. What you have to do is go to our website. You'll see free offerings, sign up for it, be out in the mail to you, and I'm talking obviously your email account, www.iraepstein.com, or call my staff. Easiest way to get it. While you're on the phone with them, they'll probably mail it right out to you. You can always click here, take you to our free offers. You have a good day.